The U.S. Federal Reserve has cut interest rates for the first time this year, lowering its key rate by 25 basis points. Hafiz Noordin of TD Asset Management joined us with more. And Hafiz, as I mentioned, it was just 25 basis points, despite a lot of political pressure for more aggressive cuts. What stood out for you today?
Yeah, well, that 25 basis point rate cut was priced in, so it was very much expected by the market. So no surprise there. But so what I was really looking for, though, was to your point, was there anything in the statement that showed that there was pressure to or a leaning towards a 50 beep rate cut? How did the dot plot, which was updated in this time, look in terms of projections for the rest of the year and for next year in terms of what was forecasted by the FOMC, and then what came out of the press conference, because that's an opportunity to provide a little more nuance from Chair Powell. And so I think what I really took away from the statement was that it definitely leaned a little more dovish. We didn't see dissents by, we only saw a dissent by Stephen Miron, who was newly appointed and basically kind of provides a voice for President Trump there. But despite that, we still saw kind of more dovish inputs by other members of the board. And there was definitely acknowledgement that labor markets have softened and that downside risks to employment have increased in the U.S. And that justifies the cut today, but also justifies likely cuts over the coming year. And so I think that's what really stood out, is that there was definitely a dovish lean in the statement, but Chair Powell definitely walked that back a little bit. So I think what's evident out of all of this is that there's tension on the Federal Reserve Board around how to proceed with downside risk to jobs, but still sticky inflation.
Okay, so given this tension within the Fed, how's the market digesting this new dynamic?
Yeah, so I would say that again, because the 25 beep rate cut was priced in, there's then a bit of a high bar for the Fed to be more dovish than what's priced in. And the market had priced in essentially 6 cuts over the next 1 year, including today's. So 150 basis points of total cuts from now until the middle of next year. And so there was a fair amount of cuts already priced in. And so from that perspective, there wasn't anything new in saying that labor markets, that there was any downside, in terms of labor markets. And I think what seemed to move the markets a little bit more was this idea that Chair Powell kind of characterized this as a risk management cut, and that there's still maybe some more data dependency than what had been perceived going into the meeting. And so I think there's positioning in the market had been for more dovishness, and I think that's being walked back a little bit.
Now, the Fed has talked about the weakness in the labor market as well as concerns over inflation. What are the potential risks to the Fed's outlook given this rate decision today?
Yeah, so I would say inflation would be the main one where, if you kind of rewind to a year ago when they started the rate cutting cycle, inflation was more on a clear downward path from kind of 3 towards 2.5. This time around, there's obviously a lot of noise from tariffs, but you actually do see core inflation increasing to a little bit over 3% by the end of this year, and then stabilizing very gradually to 2.5 by kind of the end of next year. And so I think the risk for sure is that if there is a lot of influence on the Federal Reserve to cut rates aggressively, even if economic data is rebounding, that could cause an increase in inflation. But I think it'd take a while for that to play out. So it doesn't necessarily mean that it'll stop them from cutting rates over the next few months. But it is something to watch out for. But I think what's really interesting is that the Trump administration, seems to be thinking about this and may look at other ways of managing bond yields so that inflation doesn't necessarily derail markets. So I think it's going to be a fascinating narrative to follow.
All right. So given your outlook on rates, what does this potentially mean for the U.S. dollar going forward?
So we saw the U.S. dollar, come down a bit as rate cuts were getting priced in over the summer. And I think, the sort of knee-jerk reaction from today's meeting has been that bond yields have moved up a little bit. So again, they already were priced for the cut. And with some of that, somewhat, I'd say more balanced language from Powell, the U.S. dollar is appreciating a little bit here. So for the Canadian dollar, where we got the Bank of Canada cutting this morning, we've seen the Canadian dollar kind of around 72 to 74 cents versus the U.S. dollar. And it seems like that range will probably still hold for a little while. That 72 to 74 cents has held since around April, since all of the noise from the Liberation Day. I think it'll probably take some bigger kind of catalysts to move out of that 72 to 74 range. But I think if let's say the economic data in the U.S. were to come in a little bit stronger than what's expected, if we see a rebound in labor market data, then I think we could see the Canadian dollar move towards more of a 70 to 72 cent range versus the U.S. So I think a lot of it will depend on the data. But at the end of the day, we know the Trump administration wants to see a weaker U.S. dollar. So I think it's going to be, very interesting to see how, the administration, what their goals are and what the market ends up doing with the data that comes in.
Okay, so given what's happened and all the sort of balls in the air, what are the indicators that you'll be watching closely as the Fed considers its next move?
Yeah, so I talked about inflation data. Over the next little while, I would say the inflation data may not actually move things a whole lot because it's already expected that it's going to be a little bit stickier, a little bit closer to 3%, and a lot of that is from the tariff noise. So I don't think that necessarily moves things a lot. It's really the labor market data that we have to watch. The monthly jobs data out of the U.S. is really the focal point. But having said that, I think there's a lot more attention on higher frequency job data that's a little bit better at being forward-looking compared to the monthly non-farm payroll, which has been kind of had a bit of there's been some concerns about data quality. And I think when you see some of the higher frequency data like jobless claims, initial jobless claims that comes out every Thursday, that you can see has had a lot more influence on markets. So I think watching some of those data points to see early signs of more layoffs, that is what could sort of change the narrative right now, which is more of this low hiring but also low firing mode that we're in.